Kenny, it's so nice to have you back. And you're here on a day when the markets are all green. So what are you watching?
So what am I watching? I'm kind of watching the action that's happening in the markets, considering, once again, that we were told yesterday that there's no inflation, there's no reason to worry, there's no interest rate increases coming. So once again, we're into this Tina trade, right? There is no alternative. And so I'm watching once again as we see the rotation happen from a little bit out of value back into growth as the NASDAQ continues to surge well ahead of all the other indexes, right? And so at the moment, that's what I'm watching, and I'm starting to prepare for what's going to happen tomorrow when we get the producer price index.
You know, Kenny, I've been interviewing you for years now, and I've always been mentioning your newsletter and how your recipes always inspire me to cook. But you recently told me that you're actually starting to do something new and different. You're actually on Instagram now. And the reason that I'm bringing this up is because you actually made me laugh out loud early this morning, which is pretty impossible before I have coffee, because of your comments on inflation.
Well, yeah. Well, so I have a very strong feeling. But yes, to answer the first question, I started posting Instagram TV videos like recap market commentary early in the morning, probably about 7:30 by the time it goes down. It's like, between 8 and 10 minutes long. I just talk about what's happened in the markets, what's going to happen today. It's kind of a paraphrase of the daily note that I write that you can find out on Twitter, on my LinkedIn, but now you'll see it in video fashion on Instagram, on my Instagram, via Instagram TV. But we were specifically talking about inflation, right? This week it was all about the CPI yesterday and the PPI tomorrow. And so what's frustrating to me, and I think a lot of other people out there, is that a couple of weeks ago when PPI last month reported that at the producer level, prices were skyrocketing. The estimate that was, 0.3% and 0.2% ex-food and energy came in at 1.3% and 1.2%, a full percentage point above what the street was expecting. And that started that rumbling about coming inflation and how long it was going to take before producer prices, trickled down to the consumer. And the producer was not going to eat these rising costs any longer. And ultimately, they were going to be passed on. And that's what caused the turmoil in the markets, because then it went to rising rates, and we saw a weak debt auction, and so we saw yields spike, and then everyone knows what happened from there, right? The market took a hit. NASDAQ took a bigger hit because naturally money came out of all the high growth names, as we'd also been talking about, as 2021 appears to be a rotation from growth to value. And in fact, that up till this point has been true because value is ahead. Year to date, it's up 13%, the value trade, and the growth trade is up 3%. Now, after today, might be a little bit better, but one way or the other, yesterday, what we got was consumer price index. And you saw what the estimate was for 0.4 on the top line and 0.2 ex food and energy. And what's interesting, food and energy is something that every one of us needs, that no matter what price it is, you got to go out and buy chicken and steak and macaroni and whatever it is you got to buy because you got to live. And you need energy because you got to heat your house, you got to air condition your house, you got to drive your car, we got to move stuff around. And so they take that out because that tends to be volatile because those prices move up and down. And so yesterday, in anticipation of yesterday, I came out and said, okay, last month's producer price index showed this big increase, much bigger than anyone expected. So that's got to whittle its way down to the consumer. So I expected to see the consumer price index yesterday at least be elevated, even if it was a tiny bit, to suggest that what the producer prices were saying was in fact real. What we got yesterday was no inflation, nothing, zero, not even a hint of it. Why is anyone concerned? What are we talking about? Don't be ridiculous. Go away. There's nothing. And it makes no sense to me at all. Now, what we had yesterday afternoon when people started questioning the CPI versus the PPI, you had all these economists who come out and say, but listen, it typically takes 2 or 3 months for it to trickle down. So we have to wait now until late April, early May to see what the producer prices did in February, what they're going to do to the consumer prices in May. So I'm not suggesting that there isn't, but what I did say was when I saw the CPI yesterday, when it showed not only that there was no inflation, but it actually showed that the report was actually less than even what the estimate was. It causes my head to blow off my shoulders because I'm sitting there going, okay, somebody's playing, I got a secret. And, typically it's the government who's reporting it. So the last thing the government wants to do at the moment is suggest that that they've lost control of inflation or that yields are going to start to spike because, look, the littlest hint caused the market to start to reprice. You saw the NASDAQ lost, the index itself lost 11% of its value. But then you saw individual names get crushed even more. Zoom down 47%, Tesla down 38%, Shopify, Spotify, all those stocks down 30%, right? And so the last thing they want to see is this unsettling, especially when, Jay Powell and all the other talking Fed heads are coming out telling everybody, no, don't worry, it's good. We got it all under control. And so I'm frustrated because you're getting contrary indications between what the PPI says, what the CPI says. Now, tomorrow we're going to get PPI again. So it's going to be interesting to see what this month's report on PPI says. Is it still elevated? Because the estimates are right in line at plus, 0.4% on the top line and plus 0.3% ex food and energy. So it's going to be interesting to see if this one mimics what happened last month.
Now, Kenny, a rotation that Jeff Mark, senior portfolio analyst with Action Alerts Plus, who has been co-hosting the show with me this week, was noting was that he thinks that the rotation into cyclicals that he doesn't think that it's over. Do you agree with that?
No, I don't think it's over either. Now, I think today it might appear as if there's this movement out of some of those cyclical, quote, value names into the high growth names. And I think that's a direct result of what happened yesterday when the CPI came out weak. The debt auction was fairly strong, so yields held at 1.5%. Listen, and this morning, you also had the ECB, right? The European Central Bank, Christine Lagarde, President, European Central Bank, come out at 12:30 their time, 8:30 our time, to say that the ECB is also concerned about rising rates and they're going to start to buy more bonds and that's going to cap yields, right? So if they do that, if they succeed in capping yields at 1.5%, then I think the market takes off again. And I think money will move into the growth names once again. I don't think that's going to happen. I think rates are still going up. I think rates are going to be 2% by the end of the year, which is not the end of the world because it's 9 months out. So if it takes us 9 months to get to 2%, that's okay because the market will adjust. But I do think then the value cyclical trade will remain alive and well because all that means to me is that if rates get to 2% and inflation does start to tick up because they do expect, even Powell has said, we're going to let it run hot for a while. Hot just means they haven't defined what hot means. Does hot mean hot enough to burn you, or does hot mean just enough to keep you nice and cozy warm? They haven't really defined it yet, right? And so it's going to be interesting to see how the market reacts. But no, I don't think the value cyclical trade is over at all. And look, energy is a perfect example. Look what's happened to energy. It was dead money for a number of years. It is on fire. And talk about a value trade. There it is. And energy is only going higher. Once the world wakes up, once the United States wakes up, talk about the demand. You can feel it. It's about to explode. I'm down here in Florida. You can feel it. You can feel it that people are just dying to get out. And the people that have already gotten their vaccinations are no longer being stuck inside the house. They're out to dinner. They're out shopping. They've already started traveling. You can feel it. You can see it. And when that happens, guess what? Demand for energy is once again going to go through the roof, and we're already at $70 a barrel. Gas has already gone up 45% in the last 6 weeks, and it's only going to go higher as we move into the spring, summer driving season, which hasn't really even begun yet.
Kenny, another sector that I want to talk to you about, and I hope that you get as heated about this one as you just did about energy, tech. We have the NASDAQ up 1.8% as of 10:38 a.m. this morning, and this is based on the inflation that we've been discussing, but how are you approaching tech now?
So listen, I like tech. I'm not saying anybody should ever get out of tech, but you have to look at the tech is much bigger, and you and I have had this conversation. The tech is much bigger than 5 names. Tech is not just FANG stocks, right? There's so many other places in technology. And I actually think cybersecurity, specifically based on what's happened just this week alone with that Microsoft breach and what that means. And all it does is raise people's awareness once again that we live in a dangerous world and that technology certainly is going to be the next, somebody, I forget who somebody said it on TV. That's going to be the next pandemic, is going to be some real big technology breach. And so cybersecurity is technology, right? So that's going to be a place that you have to look at. Look, I'm not a Facebook user, which is kind of a lie because I use Instagram. I guess that they own Instagram, so I guess you could weave it together. But on Facebook specifically, I'm not a Facebook user, so I won't buy Facebook. I just don't buy Facebook. I don't use it. I won't buy it. I don't care what it does. It's just not a name that I'm in. But technology as a sector, and there are so many subsectors within technology, whether it's clean energy technology, whether it's semis, whether it's cybersecurity, whether it's Internet of Things. Those are so many places where you can find opportunity, not only this year, but in the years ahead. So technology should have a place in your portfolio for sure. I'm not one of these people that's panicking, oh, no, get out of tech. Absolutely not. I own my Apple. I'm never selling Apple. Why would anybody sell Apple? Have you seen what they've done to the world? So, no, I think tech absolutely has a place. Absolutely has a place in your portfolio.
I mean, that's literally what Jim Cramer says. Own it, don't trade it when it comes to Apple.
Why would you ever? I mean, listen, I guess sometimes there's times where you need to raise some cash. Maybe you take a little bit off the top, but never. I just keep buying it. And I'm not buying it like on a day like today. Look, the market's rallying again today. What am I doing? I'm doing absolutely nothing. And people go, oh my God, you got to go in and buy. No, I don't have to go in and buy because I'm already invested. So the market's moving up. Guess what? I'm participating. It's not like I'm sitting here going, oh my God, I'm not even in. I'm in. So I'm participating. But I got cash on the side. Today's not the day where I'm going in just because everyone said, oh God, I got to get in. I'm going to miss out on this trade. I'm not missing out on anything. And so I play it from patience is a virtue. And we saw that a couple of weeks ago because going into that, all during January and February, in my morning note, I would say to people, don't chase the names. Patience is a virtue. You're already invested. You've got a portfolio. If the market rallies, you are participating. So there's no reason for you to get nervous. Take advantage when the market pulls back. And bang, 2 weeks ago, you got that opportunity. Right?
So Kenny,
why would I buy JP Morgan today at $156 when I bought it two weeks ago when it came under pressure at $141? I wouldn't. I bought $141. I'm going to leave it now.
No FOMO over here, folks. Kenny, let's talk about the stimulus bill really quickly because we're seeing that a lot of younger investors are going to come in and start using that $1,400 check that they're expected to get to put that into the stock market. And I've been asking this to pretty much everyone I've been bringing on because I think that this is interesting to get a slew of advice. So what's your advice here? How can they best put that money to work if they're going to put it into the stocks market?
Okay, well, let me just start by saying one thing. If you're somebody who's receiving a stimulus check, the $1,400, the assumption is because you need it. This is where I go off the rails a little bit. If you're getting a $1,400 check, the assumption is because you're having a difficult time, you need to put food on your table, you need to help pay the rent, whatever. And I think that's admirable. I think it's absolutely the right thing to do. I think you deserve the check. I'm happy to give it to you. What frustrates me is what I've been seeing in the news that the 25 to 35-year-old group is going to take their $1,400 and put it in the stock market. And I think to myself, okay, that's great. I get it. But if we're sending you a check for $1,400 and you're not using it for food or rent, that means you're apparently not having a problem with food or rent, that you're still gainfully employed, you can pay your bills. Why is the country giving you the $1,400 then? We should be giving it to the people that are really suffering. And trust me, there's plenty of them out there. So that's just, I'll get off that soapbox. But now, if you want to take the money and put it in the market, I'm going to tell you what they're going to do. In my mind, they're all going to run in and they're going to try to make the killing with it, right? They're going to just take it. They're going to try to put it in one of the high flyers. They're going to try to put it in another tech stock and another growth name, which is fine too. You could do that. Because if you're 25 or 30 years old, if you want to put it in a high growth tech name because you're a long-term investor and you want to leave it there and let it grow because you've got 30 years to play with it, go for it, right? You should absolutely go for it if that's what you're going to do with the money. I'm just frustrated to think that the country's going to spend, this $1.9 trillion and a bunch of people who by rights, if they put it in the stock market, don't really need it to pay their bills. But yet the country's just sending them free money to do what with? To put in the stock market? That's where it rubs me a little bit the wrong way. But if you're going to do it, that's fine. I suspect most of them are going to try to, make the score and put it in a big growth name, a big tech name, some exciting name, whether it's Roblox or whether it's Zoom or whether it's Tesla or something like that is what I suspect they'll do with it.
I'm glad that you brought up Roblox because Cathie Wood and ARK bought shares of Roblox when it went public yesterday. We've talked to Jim extensively about Wood and her investing strategy, but now I want to get your opinion. What do you make of her strategy?
So listen, I think Cathie Wood has played it brilliantly, right? You can't argue with her. She's been crowned the queen of investment management over the last year because from January 2020 through February of 2021, she was up over 200 and some odd percent in her ARK ETF. And she's been playing that high growth, sexy technology names. You know them. They're all there. It's Spotify, Shopify, Tesla, it's Zoom. And Roblox now doesn't surprise me at all. But here's what I got to tell you. Look, I'm 60, right? Or I'll be 60 in 3 weeks. My kids are grown. I don't sit around playing video games. My kids don't sit around playing video games. I don't have grandchildren yet. So therefore, no one in my family is sitting around playing video games. And I get that the country was shut down for a year. And so I get that a lot of people were stuck at home. And I get that they go on Roblox. And from what I understand, they create avatars and they go fight people and they have virtual pets and they go over to your house for tea. And when the world opens up, are you going to sit in your house with an avatar, with a virtual pet, or are you going to friggin' go outside and live your life? This is what makes me crazy. Now, listen, I get it. I live in a different world, apparently, than everyone using Roblox does. But do I think Cathie Wood has a great strategy? I think she does. Her strategy is volatile, and that's been clear. But she is also the first one to say that it's clear, right? But I do think she's on the cutting edge. And what I like about Cathie is she doesn't get deterred. I mean, when she got on TV on Monday, they had her on CNBC Monday night and then Tuesday morning because, when the growth stocks, when the NASDAQ names were getting crushed and her fund was down 40%, she got on and she goes, I haven't changed my mind. I think this is an overreaction. We don't think rates are going to rise. We think this whole thing's going to turn around. The market's broadening out. That's going to be our saving grace. And I'm all in and buying more. You know what? You know what I love about that? Is that she's got an opinion, she's got a methodology, and she said, you know what? This is what. Now, you live by the sword, you live by the sword, you die by the sword, right? But in my mind, I'm not saying she's got it wrong at all because the future is technology. The future is places like Tesla. I agree. But her fund is so weighted in those very volatile high growth names that if you're in there, you have to be willing to take that ride with her. And in the end, I think the ride ends up going this way. I do. But I like to see her on TV because I like her personality. I like her stamina. I like how she looks you right in the face and she goes, no, we don't think that. And here's what we think. And here's why we think. And you know what? I'm committing more money to it. Good for her.
I'm just going to, before we move on, I want to challenge your argument there on the video game thing for just a second, because I don't personally play Roblox, but right. I do think that there's space for both the outside, like going outside, as you said, and I think that everyone's desperate to do that, quite frankly. But there is also like the interaction that you get. Like I personally play Take-Two's Red Dead Redemption and Grand Theft Auto, and those are ways that like I can interact with my friends who I don't live by anymore. And it's a good way to after work, once you turn it off, you load that up for a bit.
Okay, so I will also I'll repeat this. I'm 60 years old, and so that's a world that's a world I don't play in. So I can appreciate what you're saying, and I get it because obviously there's a bunch of people like you that do that, and that's great. And I understand it's a form of relaxation, and I get it. But for the last year, everybody has been artificially kept in jail. Right? Kept in their house, kept locked down. I can only imagine when they open the door fully and you feel really comfortable to get outside, that you're going to want to get out of this apartment that everyone's been living in or this house and breathe the fresh air and go for a bike ride and go to the ocean and travel and see the world. I don't want to see the world as an avatar and go visit Paris as an avatar sitting at my computer in my house. I want to go to Paris. I want to smell it. I want to taste it. I want to see the people. I want to touch the people. The avatar does nothing for me. If that wasn't
Hey, that's totally fair. Now, Kenny, to get back onto market talk, I want to ask you about next week. What are you going to be watching?
So listen, because we're in this period now where we're between earnings season once again, you really have to focus on the macro data, because the macro data, the economic data here and abroad, is going to start to once again indicate what kind of the underlying pressures are, right? We'll get more confirmation about, is there inflation building? Tomorrow we're going to get that from the PPI. Next week, the 17th is going to be the FOMC rate decision, right? Because the Fed is now in this quiet mode where nobody from the Fed is allowed to come out and talk now, because they're having their meeting and they're talking about it. So there's none of that. And so the market next week is going to listen very intently to what the Fed says based on kind of the action of the last month and what's happened to the market and the underlying concerns. And we'll hear what they say. Now, I don't expect that Jay Powell or anyone from the Fed after next Wednesday is going to come out and change their tune. I think they're going to continue to carry that flag down the street, saying that they're not concerned about inflation, they're not concerned about interest rates, that they have it under control. And if it starts to heat up, that they've got tools in their toolbox to handle any spike. I think that's what we're going to continue to hear. I just don't know whether or not the market and investors are kind of tiring of that story. And if people are starting to wonder, will they really be able to control it? And I think that's my longer term concern, because look, we're in unprecedented territory. No one has ever been in this position before with all the money we've spent. Look, with this bill, we've just spent $10 trillion between last year and today, right? And Chuck Schumer told us yesterday, and don't worry, because we got more stuff up our sleeve. We're going to bring out another $3 trillion in fiscal stimulus. And if he's got his way, it's going to be by the end of the summer. And so we're spending and printing a lot of money, and it's certainly inflating things like housing. It's inflating stocks, in my opinion. Once again, stocks are getting stretched, and that's what I'm concerned about. Yes, I understand that earnings are expected to grow 20%, and that's all going to help. It will help, but my fear is that once it starts to heat up, that inflation's all of a sudden going to spike, and the Fed's going to find themselves behind the 8-ball instead of in front of the 8-ball, and that's going to be the undoing. And so I'm watching next week, as everybody should. I'm watching the macro data, because that's what it's about next week. And I mean, listen, it's always about the macro data, but once you're in earnings season, then it kind of gets waylaid, because people start concentrating on individual companies and earnings and what's it say about the future. But now there's none of that. And so now we're looking at the macro data. And so, and that's what I'm paying attention to, right? And I want to see, I want to see the market. I think we remain on the S&P. I think we remain in this broad channel that I identified a couple of months ago that I've been writing about in my note of 3770 on the downside and 4040 on the upside. And right now we're at 3935. So we're getting a little bit closer to the top of that range. But I think if the channel holds, that if we have another burst forward, that will probably hit some resistance there and then kind of churn a little bit.
All right. Thank you, as always, for joining today, Kenny. Really appreciate it. And guys, thank you for tuning in. We'll see you next week. I'm Katherine Ross, and see you on Monday.
Are we done?